Auditing accounts payable, let's talk about the definition of an audit, which is an audit is performed to verify whether the financial statements are materially correct, or the other way to put it is that they avoid material misstatement. We also, in audits now for public companies in particular, talk about reviewing internal controls, and an audit is not designed to prevent fraud, because fraud involves collusion among two or more people. So an audit is not designed to detect fraud. It is designed to determine if the financial statements are materially correct. So that being said, two things. We focus our test work on an audit on the balance sheet balances first, accounts payable, accounts receivable, cash, etc. And then, based on that work, other work will fall out and result on the income statement account. So if we're auditing accounts payable, that's going to handle some of the expense auditing. Secondly, we're most concerned with accounts payable about the understatement of accounts payable. We don't want liabilities to be understated. We don't want assets to be overstated. So this is really about the completeness assertion, those assertions that we talk about when we're doing an audit. So first thing, search for unrecorded liabilities. We're going to look at checks and other payments made shortly after year end in January to see if they relate to payables and liabilities that exist before the end of the year. So let's say we pull all the checks, we look at large checks and other payments, and we see a $5,000 payment, and we go back before year end and we see that there's a purchase order on December 27th that applies to a check that was written on January 10th. The next step is to ensure that that purchase order and that expense is recorded in the year that's being audited and not put off into the other year, because it applied to the year before, it applied to the year before 12/31. So that is search for unrecorded liabilities. Approvals. In most companies, if we purchase something above a certain dollar amount, we're going to have 2 approvals or even more people approving it. Are we complying with that rule? So maybe it's everything over $10,000. We pull $10,000 payments where they approve by more than one person. So that's approvals. Thirdly, internal controls. We want to make sure that we have processes in place to quickly reconcile the bank statement to avoid paying fictitious payees, which is someone who sends you an invoice for a fictitious client that looks very similar to a client you already do business with. The way to catch these from happening over and over is to quickly reconcile the bank statement and know who your vendors are. And then finally, are we only capitalizing things that are assets we're going to use over a long period and not avoiding expensing things? So those are some things to think about with accounts payable.